So today we're talking about Parcel, a synthetic asset protocol focused specifically on real estate. And from what I understand, it's by cities in the US. Now, there's been a lot of crypto protocols that have tried to make real estate more liquid and accessible. Some of them take individual buildings and turn them into NFTs or basically fractionalize them into NFTs. But this is a bit of a different bet. I mean, what's been your take on kind of the intersection of crypto and real estate so far, Dave?
There's always this grand promise that real estate, it's like one of the biggest assets in the world, huge
hmm
ability to unlock a huge amount of volume into crypto. But as you say, the problem is if you're just bringing on individual homes, individual assets onto the blockchain, they're not fungible. And then you've also got these issues around property rights, about how do you enforce it. You know, if there's
Right.
a property that's split up between 100 people and you lose your key, who's going to enforce the right that you did actually own that, but you've lost your NFT to it? So I think there's lots of issues around bringing real estate onto the blockchain, and I think this could be a really interesting way of going about it by actually having synthetic derivatives effectively on the per square foot price of real estate.
Yeah, absolutely. One thing I do for fun oftentimes is just read about what cities are really interesting or growing really fast in the US, or even on the other hand, like which cities have declined a lot. And, without crypto, it's really hard to take an actual view on that because you would have to literally buy a house in those cities or sell a house or short a house, which is not even possible in other cities that you think are going down. And so theoretically, protocols like Parcel that create these synthetic instruments to emulate real estate prices, it seems like pretty promising and interesting. And I think it just makes a ton of sense. And so, yeah, super exciting to just dive into this a bit more with the founder and figure out um, what the story is behind Parcel.
I think one thing that's actually interesting about it is that the normal person can have quite a good edge when it comes to localized real
Yeah.
estate markets, because you can be living in a specific area of New York. You're going to know better than the person who's sat in San Francisco and is looking at it on a national scale. So I think it's an interesting product. Everyone has a feel really for the direction of real estate property prices in their
Yeah,
cities, and yeah, I think it could be successful, but it'll be an interesting chat for sure.
definitely. Definitely. Yeah. The alpha you generate just by walking around your neighborhood could be put to use. Welcome to Unlayered, the podcast where we explore next generation blockchains. I'm your host, Saul, alongside my co host here, Dave. And today we're joined by Trevor of Parcel, founder and CEO of Parcel. Trevor, how's it going? Excited to have you today and talking about real estate and DeFi.
Great. It's going well. Thank you for having me. Great to be here.
For sure, for sure. Parcel's been one of the cool projects I've followed at a distance throughout the last year and a half or so, but haven't really had a chance to kind of think super hard about that whole space. I think when it comes to like how crypto can improve finance and DeFi, real estate's a super exciting area, and it's something that a lot of people have mentioned before. And it feels to me like Parcel's really ahead of the curve here and has actually deployed some pretty cool products on that front that are super interesting to watch.
Yeah. Yeah. It's been a journey, quite a ride. We've been at it for a couple of years. We have a great team and we're putting out products, pretty fast. So the team is innovating and executing well.
For sure, for sure. Well, tell us a bit about that. How you found this specific niche being interesting to explore within crypto. As I understand, you had a background in Wall Street, obviously covering a lot of different asset classes. What made you feel like this was kind of where you wanted to focus on?
Yeah. I think the best place to start is, my background, was, in investing in technology equity. So I was a portfolio manager at a couple hedge funds, in New York, and, it covered like software, payments, internet. So I've been familiar with blockchain pretty, intimately, since 2017. So I've been following it. And during COVID, there was a lot of real estate volatility. and one of our co-founders, Kellen, we worked together, and we were trying to figure out a way in which we could get exposure to real estate without actually owning the underlying asset. We had seen a lot of fractionalized or tokenized companies or products, and we it was our view that those are tough to scale because you need the capital to acquire the offering effectively. They're offering like slices or tokens of the underlying equity. So in order to do that, you need to acquire property. And so you need money, and then you need time. So those two the scarce resources are kind of operating as a headwind. What we wanted to do was effectively create an index that tracks the underlying pricing dynamics of real estate markets. So, in our view, the most lively elements of that are sales and listings because they are the actual price points offered to the public. What we came to realize was that there were no price indexes that track the price per square foot or price per square meter if you're denominated in that term. So we had to create that first. We had to create price feeds that track the price per square foot based on sales and listings. We do that via our data effort called Parcl Labs. Parcl Labs is a wholly owned subsidiary, and every day publishes a price point for the tradable cities on the platform. We decided to go at this time. That was like late 2020, early 2021. DeFi was showing a lot of promise as a way to distribute it, like form capital in a distributed manner. And I had been familiar with it, and it's just a very efficient technology to create an underlying exchange on. So that's kind of how that's like the genesis. I think, most of that still holds true. Blockchain is super efficient. We're on Solana, so transaction fees are really low, it's fast, and scalable. So that's effectively why we decided to build on blockchain. It was the quickest time to market. It's a novel product. There's really not there's really not anything like it, or there wasn't. And so speed to us was the way to go.
I think it'd be good just to maybe list out more clearly what the other options currently are if you want to gain exposure to the real estate market. So obviously the first one would be buying your own house, which, as you say, is definitely capitally intensive. But I mean, do you want to just go through the other ones? But I think REITs is the obvious parallel maybe in TradFi, but yeah, let you take it away.
Yeah, exactly. So you could buy a house. In the more like alternative or newer generation, there's a lot of companies who have tried to offer fractional ownership of houses or buildings. REITs are a common analogy. The REITs are different mainly in the sense that they're types of assets versus location based. So the largest REITs are data centers, distribution centers, retirement homes, and those can be dispersed across the entire country or the globe. So it's more of less about the actual underlying market and more about the type of asset that the REIT holds. And so that's would be what you're gaining exposure to if you're interested or want to get exposure to Amazon data center builds or Shopify distribution expansion. You could get exposure to that through a REIT. It's a second derivative. But the underlying real estate is less of a factor in that investment.
And tell us about the use case from a product standpoint. Is it more for people to kind of take a view on, hey, I think Las Vegas, for instance, is going to outperform other cities in terms of real estate prices. So let me make a position here and maybe I'll add some leverage to it. Like, how do you see that user journey working for people using Parcl?
Yeah, that's a great question. So, it's kind of like in the eye of the beholder. So there's a lot of, to us, to the development team at Parcl, this is something that we believe should exist in the world, a way to get exposure on or against real estate, kind of like a real estate spot market. To date, obviously like the example you said is kind of like the vanilla use case. So someone wants to get exposure, they can do that now, through Parcel. If it goes up, you make money. If it goes down, you lose. You could go short. And if it goes down, you win. There's kind of like the structural tailwind, I guess, for us, but headwind for most people, which is like unaffordability in housing. So if you're a forever renter, you can actually get exposure to the market that you're living in, that maybe you're saving up to buy a home or an apartment, but with 8% interest rates and the economy, maybe now's not the right time. So you can still get exposure to that. Institutional buyers, right? They could hedge their longs because there is no way to short real estate really. So if you, just like any other asset class, so you could own the physical and short the derivative. So, to Parcel, it's really, the option. There's many permutations as to who could use it. To us, this should exist, and we put it in the world, and we're starting to see the different use cases amongst our user personas.
I think the hedging point is a really, really interesting one. I'm just curious about, you said that you can't short real estate. It does seem strange that no one has sort of come up with this concept in TradFi before. Was it like a taboo topic really to want to short residential real estate? Because in the film with Michael Burry, The Big Short, like there's sort of a negative air around the fact that he does manage to find some sort of way to short the market. So do you think it's more a case of it's been like a taboo subject to even offer a product which could short the market, or do you think it wasn't technically feasible before? Or what do you put that down to? Because it does seem like a natural financial instrument to include in a healthy market.
Yeah, that's a good question. I don't know, especially the way that the housing system is such a big part of the U.S. economy for sure, and kind of the U.S. personal journey. You're kind of told that you own a house and part of the dream. So, and then betting against that would be kind of un-American, maybe, or something. This is speaking from an American standpoint, and then obviously there's a whole like a ecosystem around housing, right? Realtors and banks. And so, that could be it. That could be a portion of it. I think like, though, what we've seen through the data is like home prices, even though may not be huge swings, they move daily. So I think that's like the first thing to kind of understand. And then Parcel Labs, the data, it shows that. And then, every other asset class you can short, like, pretty much, in the world, you could short rates, you could short stocks, you could short oil, any commodity, right? So, I maybe because the consumer is so, and everyone who owns a home is like a mom and pop, you're betting against Main Street to some extent. But regardless, it's a neutral venue, so it's not meant to. You should have the option to express your view, and that's really what we're trying to offer.
In terms of, I guess, future product offerings, from what I understand of Parcel, and correct me if I'm wrong, but it seems like it's pretty easy to take a thematic view on either an entire city or entire country. Whereas in like the old school way of doing things, the only way to get exposure to real estate is to literally buy the building itself, or maybe through a REIT, like some collection of buildings or things like that. But it's almost like this middle ground of maybe taking a more concentrated bet, for instance, a neighborhood or a specific borough of New York City. That's a bit harder to do. Do you feel like there's interest on that front to kind of take more concentrated bets and in real estate plays, aside from going kind of citywide? Like, how do you view that?
Yeah, so that was the original idea, long Tribeca, or long
Yeah.
Brooklyn and short Tribeca, or something like that. I think, yes, that in the future, that's something we want to be able to offer. To start, just given that it's a novel product and neighborhoods are more intimate, you have some neighborhoods that are widely known, like Soho.
Yeah.
maybe Soho in London too, or Venice Beach. But, I think to start, we wanted to really find some recognizable cities, get people familiar with the product. And then from there, we can layer down. Uh, we can get to the neighborhood level. Below that, like the block level is harder because you just have sparsity of transactions. So the pricing is less free flowing. The neighborhood level is fine. So, in time, we just need to get momentum and have people understand and figure out how to roll out new neighborhoods, for example, and educate people on the differences of each. Because if you think about each market being like a product, obviously there's the products on both fronts. There's the data, there's the actual trading platform, and then each market itself is like the actual instrument. The lower you go, the more nuances there are. So we're started quasi high from the city level, and something that at least people are somewhat familiar with, especially in regards to the Case-Shiller, which is kind of the house index that the people commonly reference. So Parcel effectively has all those markets just so that you have the clear correlation to something that already exists.
So obviously the data collection is going to be hugely important, especially because I assume this is going to be something which is going to happen completely off chain, and then you use an Oracle to bring it on chain, something like that. Do you want to just talk through how you're going about sort of ensuring, I suppose, accuracy of the data, but also ensuring there's no meddling with the data. There's no funny business going on.
Yeah. So, the accuracy, there's third-party benchmarks so the one that we typically relate the data to the most is the Case-Shiller. Even though we know there's a bunch of problems with the Case-Shiller, it just is what it is. And it's normalized. There's no actual price. It's indexed. So there's no price per square foot. The Parcel Labs has an actual price per square foot, which we think is just a better relative metric and verifiable. And so regardless, every month we publish Case-Shiller predictions. The correlations with the Parcel Labs data is 0.99. So it's right there. I think initially it's all about establishing trust. We're working on partnerships with major media outlets, and then over time you'll have third parties kind of helping to verify and diagnose how accurate we are. I mean, there's some other home price indexes that update on a different cadence. We thought it was important to be daily. Most update monthly, but a lot can happen a month, especially as capital moves more quickly. Technology helps accelerate home purchases, iBuyers, et cetera. So, I think that's how thus far we've established trust and representativeness. In the future, from a technology standpoint, there is potential that the most obvious, but it's still not quite ready for prime time from a cryptographical perspective, is zero knowledge oracles. So it basically, this price going in is using this methodology, and you validate that through a zero knowledge proof, goes through the oracle, and it becomes more trustless. So that's over time where we want to go. It's just that technology is pretty early, and we haven't found one that's quite right.
One of the points you alluded to earlier is, I guess, the importance of having like liquid markets for these types of instruments. How has your experience been so far being on Solana, which has had a bit of a lull in terms of all of its DeFi protocols? That I think the guard is changing soon, and we're seeing more interest. But certainly being tethered to that ecosystem presents its own unique set of challenges there.
Yeah. So just like a little bit of the backstory, we chose Solana probably like a little over 2 years ago, probably the summer of 21. And the reason being it was fast, cheap, and scalable. And that was something that we cared about mostly on the cost side, because we didn't want more marginal costs for the user and more friction, especially in real estate where, expected returns could be lower, given the volatility of the asset itself. So fees were something we were really focused on. I think that thesis largely is true still. It's still fast, cheap, scalable. There's been a few outages, but the Solana team is working on redundancy in their new instance of it's called Fire Dancer, and that'll create another, basically another code base in a different programming language. So you reduce the risk of um, a bug in both. So it would just fail over to the other instance. So I think from that perspective, it's fine. I do think FTX and everything associated with FTX blew a hole in a lot of in the ecosystem, both from a funding perspective and then from I think they did a lot of volume on most every protocol that at least they invested in through themselves and Alameda. So I think kind of we're here. We're making the best of it. I think the technology that the team is putting out is still really good, and they're making a lot of progress. And with that, over time, I think it should be able to rebound. For us, it's really, I think, to the people that or the users that we've encountered. I think if going back in time, we were to say we started on Arbitrum, I think your floor is higher.
Yeah.
From an initial liquidity perspective, I don't know how that grows over time. And the reason why I say that is not because of Arbitrum, but it's to say that the folks that we've talked to, it's less about for the crypto native people, the chain matters, but outside of that, for institutions, it's like TradFi and blockchain. They don't know about ETH and all the dogmatic wars that go on between the different blockchains.
Yeah.
And so it's like, how do I onboard money here? Like, what wallet? How do I get it out of my bank account? Versus, oh, you're on Solana, I don't trust Solana. So I think that's really the discussions that we're having, which leads us to kind of double down on product here to make sense over time, go multi-chain. But again, we're pretty encouraged, especially with the recent Visa news. Visa is going to settle USDC on Solana. And why are they doing that? It's a result of customers asking them to be on a fast, cheap blockchain, and efficient blockchain. So that, I think, signals at least some institutional demand for the network.
For sure. That was actually going to be my next question. You mentioned earlier Arbitrum, which to me, if I were to make Parcl from scratch today in this market, feels like the best fit because you just see all these perp protocols pop up and do really well, even Hyperliquid. Like within a month of Friendtech coming out, they have a perp out and people are using it to get exposure to that thematically. And so it does feel like that degen crowd that wants access to these crazy instruments to take different views. It exists on Arbitrum today, but your point makes a ton of sense, which is, does that really translate to broader adoption once we're out of this, bear cycle? And is that the best user experience for people?
Yeah, I think if it was from scratch, it would. The thing that we, as a development team, we have limited resources. So it's like you're getting product feedback from people who really want to use it. Like, how do we need to make it better? We have a new version coming out soon, which just helps scale liquidity and adjust some of the fees that may have been punitive to traders. So it's either address that feedback or halt product development and port to Solidity and
Right.
Create hooks for the various L2s. And so we're opting for the first, and then we can assess from there. The idea is like, you want the best product to move over, or else the feedback gets really messy in terms of how we want to design the product roadmap going forward. So I think we're getting into a place where we're going to be on our third version of the platform. 2 was way better than 1. We think 3 is going to be better than 2, and it's kind of closer to a place that we're comfortable potentially going multi-chain.
just wondering about the actual mechanics that are going on under the hood. So say that you're dealing with a city which has, you think, an average price of $100 per square foot. So if someone is longing that, is the price moving away from that? Is it an AMM model? How is all of that sort of mechanics working? And then maybe my follow on is, how are you trying to balance it and make sure basically that you don't lose your shirt, when it goes all out of balance? So
Yeah. So a little history. So we started with, sorry, when I say we, it's in reference to the development company. We started with kind of what you said earlier with the CDP AMM combo. So basically, let's just say Brooklyn trades at $500 a square foot. Someone would have to come in and mint that in a debt position or like a vault. Then you've minted a synthetic Brooklyn token, and then they would pull that with USDC to create an AMM trading experience. What we found in that is the peg would deviate because there's no natural way to bring that back down. So that $500 could get bid up to infinity, and there's not a way to bring it back down. So that's when we went to our V2, which is a PvP AMM. So everyone gets the price that the Oracle prints. What changes is longs pay shorts, and then there's optional liquidity providers. There's an LP token that kind of bears it's like the accounting mechanism such that it alters depending on trader P&L. So if traders lose money, the token that starts at 1 goes up. If they make money, it goes down. And generally speaking, the way in which balance is achieved is through a funding rate and skew cost. So if you're on the dominant side, if something is 50% or more long and you add to the long, you'll pay a funding rate, and vice versa. If you're on the short side of that, you're receiving funding. So there's balancing mechanisms to ensure that, that skew doesn't get too far out of whack to impair the capital provided by the other side or liquidity providers. Though where we're going is a simpler model. Even still, it's one LP pool for all markets. Right now, there's a pool for each. So one LP pool that is effectively a margin facility, and it underwrites all trades long and short. Versus right now, it's pretty fragmented. So the new model, more simple, same funding rate mechanics. You'll still have skew impact fees. We do think there are some enhancements to the funding rate to make it such that it's not as punitive. And that will help, I think, scale liquidity, those things taken in combination.
So far, just based on initial user feedback and adoption, has there been any surprising findings or particular instruments that you found people really like that have informed your roadmap?
Yeah, we've had a few kind of large players wanting more liquidity. I think they'll see an opportunity to create investment strategies on top of Parcl in which they can actually charge management fees. So like a hedge fund could have a pool of capital dedicated to a liquid real estate trading strategy underpinned by Parcl. So, in order for that to happen, fees need to be appropriate, especially in relation to volatility. I think that's one of the things that it's not so clear because, the Bitcoin perp funding rates can be very high because the volatility of the asset is very high. So trying to tinker with that and get it to a good spot that's manageable and digestible for people, and then liquidity as well. But I think the feedback is kind of somewhat aligned with the thesis of wanting to be able to trade real estate just like any other asset class.
And how do you think the liquidity will flow in like in the next 2 years or maybe by the next bull run? What do you think is kind of the key strategy there? Is a potential token a part of that? Or is it just continuing to build up the product offering and catering to these kind of bigger players that want to use it?
Yeah. Yeah, that's a great question. So we've been pretty organic. We haven't, everything to date has been generally organic. In terms of like incentives, we have wanted to be prudent. We wanted to make sure that the product is in a good spot, because you don't have that many shots on goal in terms of incentives. So we're really excited about uh, a loyalty program that we're going to line up with V3. I think that'll be kind of like the precursor to further distribution of the network, and that'll be um, eh, the points will be awarded for actions on the platform, such as liquidity provision, open interest, balancing markets. So if the market is really tilted long, you get extra points for being short. That'll be phase one of the program, and then we can layer on things like referrals, etc. And then eventually we can look into further decentralization if it makes sense.
I do feel like this points meta, it definitely seems to be leading the way, doesn't it, going into hopefully the next bull market. I mean, a lot of people do push back against it and say that the teams can sort of change their rewards, the eventual rewards at a later point, and that it's maybe it's like heads I win, tails you lose. Like the team can always choose how they're going to play it. But how are
Yeah.
you seeing it? Because it does seem sensible, and I suppose at least you can really sort of hit those KPIs that are most important to you and to your platform with it. But yeah, just wondering to get your view on that.
Yeah, I think if it's kind of like anything, it can be gamed. If the team is acting good faith, then there's some planning ahead of what the points are actually for, and those targets stay relatively stagnant and intact. Um, yeah, I think it's a good thing overall. Obviously, in any, whether it's points or any other anything, if there's funny business or a contract that kind of one party is not holding their end, like that's not going to end well. So it's about just staying to your word as good as you can, and then in the health for the health of the actual product. So if there's like a lot of gaming, it goes both ways, right? Because it's like if you know you put out something, you hope that it is acting as intended. However, if it's not, and then it becomes toxic, like the team has to have the right to not make it toxic for the people that are here for the utility of the product. So, if that's the reasoning, I think that's fair. Because it's being driven by malicious is a strong word, but it's driven by behavior that's not healthy. So I am in favor of that, and that's kind of like the benefit of point. They're kind of they're kind of out there, and they're not anything, but they are something. So the goal is to have them be worth something. They're definitely going to be worth something. We're gonna stick true to what we say, and anything that changes will be very well communicated.
Yeah, I think that's one of the key challenges that we saw with early, um, let's call them vampire attackers, like Looksfare, things like that, where before the debut of point systems, you kind of just attracted all the mercenary capitalists and they would script the protocol for everyone else and all the data would get all out of whack with the wash trading. So I think it makes sense to
Yeah,
decouple the actual issuance of the token, create that gap, correct for any bad behavior, so on and so forth, and try to get the alignment as tight as possible with the end user.
yeah, exactly. You want to be able to. It's like lower risk tokenomics, and you can then see what works and what doesn't. Because when it's in the code, it's permanent for the most
Yeah.
part. So this is a way to do it in a way, because in theory that people are stakeholders of the platform, and so the goal of everyone should be to have the, the most, the most balanced, the healthiest dynamics, possible. And so, anything that alters from that needs to be adjusted, and that's for the benefit of the project as a whole.
One actually broader point I want to touch on is, and this is true for a lot of projects, but I think especially for you guys, just given how tethered real estate markets are to macro,
Hmm.
versus, I think a lot of people have the view that crypto might be decoupling from equities and risk on assets. And whether that plays out or not remains to be seen. But certainly real estate is very much more in lockstep with macro. So what's been your experience so far? Because you started back when the markets were obviously in a better spot, I think, for a lot of us. And now we're skating towards this different regime from a macro
That's
standpoint. And
one
all
way
of
to put
these,
it.
yeah, yeah. And all of these cities are probably going to be pretty correlated. So just how do you think about building in this current economic environment?
In terms of the macro, or how the trades are related.
Yeah, I think a little bit of both. Just macro, like maybe there's a scenario where like real estate falls off a cliff just broadly, and like how that could impact the platform, or maybe it's an opportunity for people too because you take the other side. Just how do you view that landscape?
Yeah, I would say, so yeah, macro. I mean, I'll start with like building in a different macro. We did our first version last July. I would say things peaked probably in April of 2022. Capital was flowing in. Last July wasn't bad though, and then I think FTX kind of just
Yeah, that
crushed
was the nail in the coffin.
everything. Yeah, because it was like it was going down, but there wasn't like a real like, oh wow, like everyone needs to pull their money out situation. It was kind of like, oh, like, bubble burst, but not like a huge fraud.
Yeah.
In which like everyone was invested in large amounts of money. So at least from their equity perspective. So it just makes it harder to the trust goes out the window. I think Solana gets like the added benefit of being associated with that. And then capital kind of just dries up overall. Like people lost a lot of money across everywhere, so there's less money to go in. From for us, generally speaking, when you really think about it, it's real estate versus USDC. Uh, oh, of course, and then the USDC DPEG was like another
Yeah.
thing, but the circle handled that well, giving us more confidence in our choice to be with them. So yeah, we're really US dollars versus real estate when you think about it. And we use blockchain as the settlement layer and the exchange layer. Nonetheless, I think a lot of the like onboarding and there's just like that still like that the wallet situation, and there's just still a lot of friction for which the reason why I'm bringing that up is that if this space is in a better place from a macro perspective, innovation happens faster because there's funding and there's teams coming here and there's talent. And so if that goes the other way, like the problems get solved slower because there's not teams working on the biggest pain points. Um, Things that would seem quite easy, just like a better wallet infrastructure, onboarding, etc., making it like very, very simple. It happens at a slower pace. So, and then lastly, with respect to the market themselves, there's been a decent dispersion. So, we're neutral. So, um, it's a venue for long and short. Um, and then when you think about, most investments, at least nowadays, are most of the time correlated with interest rates. That's from crypto at the far end to maybe housing or actual bonds at the low end. So, um, I think that's obviously always going to be a function. When it comes to the markets themselves, there's been a decent amount of dispersion across them. I think at the beginning of the year, uh, most markets were up, but some like a lot more than others. it just like Boston was like on fire, Philly on fire, and that's still like Boston up like 20% in 6 months, or 3 months, which is just crazy to see. And that would outpace anything else by like 10%. So you could still run like a neutral strategy, even if they're all up, by picking the relative winner.
In my head, I'm trying to work out how big this market could be. And to do that, I'm trying to work out who are going to be the guys who are like really going to love this product. Because I think there's one potential issue that some people have, which is if you're a large institution, you want to gain exposure to real estate, you can invest in REITs and ETFs. And if you want residential, you could go for the ones that specialize in PRS, private rent sector. But what they also spit out is the yield, which you're getting from that real estate. So they have to forfeit that in order to use your product. Likewise, if you can't afford a home yourself, you could own a share of a home. And again, you could receive the yield that would come from that. So do you think that that could be an issue? Does it impact the market size? And who do you think are going to be the guys to really benefit from the product offering?
Yes. I think it's different. It's a different product. Obviously yield, like real estate's a great investment. And I wouldn't anticipate, people foregoing the actual physical well, especially if money's not a factor. At the same time, I would say that on that side in particular, hedging, reducing risk, reducing volatility on the short side, because there's no way to actually short, is a large opportunity. Portfolio protection, portfolio insurance, native price insurance. I think that market for the institutions actually is probably bigger than the long side. And again, I think there's a large retail market here because at least the younger generation, like their shot of owning a home that they like to live in is shrinking. And then a lot of the bigger players are actually buying homes for rent, the SFR, single family rental space. So I think that would be like the balancing mechanism there. And then, hedge funds, just if there's a route to create a product to charge fees on, and you have liquidity, I think that's really like the key here. It threads the needle between what you're saying on the institutional side versus retail. It's like the bigger, that's like highly active managed money. And the reason why they'd be interested is because they can create products, like new products there, and charge fees.
I completely agree on the hedging side. I was looking up before this interview about how do real estate companies who are developing the properties themselves actually hedge against the possibility that the rents are going to come down. And they don't really have anything. All I could really see is that they hedge against the interest rates going up, because obviously they're borrowing, they're leveraging up to acquire and to develop these assets. So you do generally hedge that risk out, but I don't think they really do anything to hedge out the possibility that the market you're building in is actually, the demand is going to fall away, that there could be a COVID-19 incident, there could be a 2008 financial crisis incident, or it could just be, the fad moves on to a new location, and there isn't really an easy way to mitigate that risk. And these big corporations, they want all the risks to be hedged.
Yeah, it's like they're okay to forfeit some. The individual could be like, let it ride. But I think in the larger side, like reducing risk. What does reducing risk mean? It means that you can. It really means that you can add more leverage or get more like the lower risk you are, the more dollars you can hold, whether that be natively or through leverage. You could borrow against a T-bill. You can borrow against the government in much bigger dollars than you could borrow against Ethereum, right? Because one is way riskier than the other, or like a different type of stock. So I think that's really the key for them is isolating idiosyncratic. What are the returns they're seeking to get? Maybe it is for the market. like they think Nashville is going up and that's their thesis, or they think they could make the home nicer and flip it based on the home itself, and they don't want the underlying market risk. They just want to lock in. I can add a kitchen, bathrooms, and this is the profit that I can expect to return. So it makes the returns more predictable as well.
So Trevor, you're obviously super deep into all of this real estate data. Would love to get your view on where you see this sector going. You brought up some interesting points, such as young people feel like they're kind of priced out of the houses they want, as well as just the fact that interest rates are up and people are spending more of their income on interest payments versus principal on their mortgages. What are you noticing, like just higher level, like where is real estate going and what impact do you think that'll have? Or what trends are you kind of paying attention to?
Yeah, so I would say that I've been pretty surprised at the resilience of the markets generally. Like, I think it was widely consensus that at the beginning of the year, post the rally of rates, that home prices would go down, and they all went like up 10 or 20%, which is
Yeah.
pretty surprising. They've cooled off a little, but have come back some. So, it's puzzling, I would say, to
Right.
figure out why. One potential reason is there's just like a huge mismatch or maybe like a stalemate. Obviously, if you have a 3% mortgage, you don't want to, if you sell it, unless you have all equity,
Right.
and you can put that as a down payment, like there's not really a place to go, because now your payment, especially on interest, will be double or more. So, and then an economy that's like fine, but not, well, it seems fine. I don't actually know, but it seems okay. If you're not like materially increasing your net worth or your income, like what gives? So I think people are not selling, and then buyers aren't willing to take the 8% mortgage, really. So there's like a lack of transactions. And then on the back of that, we're seeing a ton of single family rental acceleration. There's there's players that we're used to, but then more and more people or more and more institutions are raising capital to buy homes because they can either acquire mortgages at a lower rate or borrow against other assets that they have, in order to make the economics work. So that's a trend that could be a very large trend in the future. Is the single family rental market.
So I've seen so many headlines about that kind of movement, and I guess a lot of concern amongst retail people, like, why are these big institutions buying up all these houses and renting out the neighborhoods essentially? I guess my question is, why is it really just a return thing? Like, why the interest in single family homes now for these bigger players? Is there something else that we're missing here?
I don't know why now. It's accelerating for sure. I think if they can capture an arbitrage on the interest rates,
Yeah.
you have more demand, right? Like if they can get I don't know what rates they're getting, but it's definitely lower than the market. So if they can capture that spread, and being less financially, they're insensitive almost to the home prices. And whereas the consumer is very sensitive to interest rates and mortgage rates. So they could capture that and then charge whatever uh, the property would deem as the appropriate mortgage payment, and they could get that back via that spread. So I mean that is one thesis, and then it's just more profitable versus some of the other things they were doing before. Especially the other thing is like commercial is kind of
Yeah.
with work from home. It's like you used to invest in commercial property, but vacancy rates are up or underutilized. So where are they going to put the cash that they once were deploying? I don't think you'd really want to deploy into commercial. There's probably enough inventory to satisfy demand, or there's probably a lot more inventory than demand. So, they're looking for other avenues to deploy capital in real estate, and homes, obviously, given the dynamics that I just mentioned, are attractive, especially if they can capture a better mortgage rate than the consumer.
I'd love to get your take on how you see the future of real world assets in crypto, and specifically with regards to real estate, because did you look at that as a potential option, more what Homebase, another project on Solana, are doing to actually fractionalize real assets and bring them onto blockchain? Do you think that works with real estate?
I think yeah. So the Homebase guys, great. They're friends and they're awesome. I think it works at scale. I think to get there, as I mentioned at the very beginning, it takes time and money to get enough scale, and those two things obviously are the scarcest things in the world. So I think the way that we're coming at it in the future, ideally, would be able to unlock some of that, right? Because how do you have a secondary market if there's no price in order to mark the positions against? It's the same exact problem as the V1, where you don't have a peg. So ideally, in the future, if Homebase had a bunch of properties in Soho, we have a Soho price feed. They can mark the shares of Soho, their properties in Soho, against the price feed to allow trading between those two things, and then you get more liquidity in the space overall. Versus now, it's just home by home, and those homes can fill up really fast. You can't really satisfy the actual underlying pent up demands one by one. So you need a way to unlock it. I think that's our goal, is to be able to unlock that liquidity at the physical layer. I think you do that by having a dynamic, dynamic pricing layer. And then with respect to other real world, this kind of goes back to my other point, where more funding into the space that helps automate a lot of the process, like deeds, verification of the counterparty risk, etc. The more automated and advanced that can get, I think it would help a lot, because you can loan and know that who you're loaning to, is trustworthy and creditworthy, and there's recourse if the loan goes bad, or there's all that stuff that is very manual today, and that would maybe less so. I mean, there's tenant risk, of course, and damage, like fires and floods, etc. But on the other side of real world assets, where you're lending against businesses and cars, so you just need a lot of that infrastructure to spin up.
I want to actually, because just based on this response you gave, it reminded me of some earlier points you made, and kind of shift over to the operator side of building Parcl, where it's not just about building the protocol and these instruments for people to trade. It's all of the necessary infrastructure that goes around it, whether it's the off-chain stuff or the on-chain stuff. You mentioned earlier some pain points with just the wallet experience in and of itself, creating friction for users. Talk to us a bit about what pain points you're feeling as a builder in this space. Like, what things do you think we still need to work on and improve to actually make this a piece of technology that a lot of people could use?
Yeah. So, funny enough, I think Phantom and is the best wallet, and it's just more seamless than the other options. The more abstractable it can get, such that it feels just like a regular app. It's not. So it's just, it's foreign, right? It's not hard. It's just not what people are used to. So I think that's really something that, we try to build as much of those in on ramps. We integrate MoonPay. But the more that it can just look and feel like a regular, like a wallet in some sort of abstracted way, would be, I think, the best thing. Just so it's the blockchain part, the best part of it, which is like the efficiency that you can have running on one of these networks, is abstracted, and it's just very clean, clear. It's just, we're working to that. It's just, I feel like it should have been here by now, but it's still one of those, it's kind of like it's elusive to some respects.
Yeah, I totally agree. I have the view that the era of like Chrome browser wallets it's getting towards the end. I don't think that's how most people are going to use crypto, especially Mark Cuban lost, $1 million on his MetaMask. If you can't figure it out, I don't think anyone can.
Yeah. Oh, and then like like that type of stuff, like, some sort of backup, something where it's just like, if you lose this 12-word thing, you're completely out of luck. Like, that's very risky. That like brings the addressable market down by probably a pretty good amount.
Definitely.
Things like that, where it's just like the niceties that everyone has created to date, just building on top of that and not moving backward.
Right. I'm personally bullish things like NPC wallets that we saw experience with this with Friend Tech, where it's headless transaction signing, no pop-ups, and log in with your email or your phone, you shard the key on the device. That stuff, I think.
Yeah, the app that they made was really cool. How it's like a app, but it's downloaded from the browser, so you kind of go around. Yeah, that was smooth. Like that experience was really cool.
Totally. Well, I think we're getting towards the end here, but I think closing question for me, and you brought up earlier V3's on the horizon. What features is it going to bring out? It looks like the loyalty program is going to be a big part of it, but what else should we be excited for?
Yeah, so V3 will be a better user experience from multiple facets. I think scaling liquidity allows a broader set of people to enter the market and play in the size that they want. We'll also, so that's the main feature. But we'll also be adding incremental features to the portfolio page, which is where you can track your investments over time. Before, we didn't have the indexing capability. We just hadn't prioritized it, but we'll have indexing to wallets and all transactions, so you can have a nice review of exactly what you're going to be, or exactly how your performance over any period of time. And then, loyalty points as well. So starting to bring the community along for the ride. Again, we'll start with a first version. We're really excited about it. And then we'll continue to enhance the loyalty points, and then eventually figure out how to deploy those points further to the users.
Are you also looking to improve the market data? Because I had a quick look earlier and you had like absorption rates and things like that. So is that another area that you're looking to build out?
Yeah, we'll continue to add metrics and things that help people make investment decisions.
Amazing. It looks like quite the feature set to be excited for. Well, Trevor, thank you so much for taking the time to join us and talking about all things Parcl. It's been on our docket to kind of do a deep dive into this for a while now. So excited that we finally made it happen.
All right, guys. Thanks so much. Really appreciate the time.
Awesome.